7 discusses financial statement analysis. And the first one the textbook talks about is completing a horizontal analysis. So an important element of running any business is to analyze its performance. This typically consists of making comparisons between the company's account balances for the most recent period and some other useful benchmarks. So the list of benchmarks that the text describes is prior performance, competitors' balances, and industry standards. So we're going to look at a horizontal analysis of Wilson Legal Advisors. And what we're going to do is we're just going to type in all of the revenues. So we'll have sales revenue, interest revenue, and then you have your total revenues there. Now our expenses include rent expense, insurance expense, depreciation expense, utilities expense, supplies expense, telephone expense, miscellaneous expense, and then you have your total expenses at the bottom here. So what I'm going to do is I'm just going to go through these and get rid of these since we're not going to be using them. So I'll just delete these from here. And I'm going to delete this one. So we have up into our total revenues and our total expenses here. A horizontal analysis of Wilson Legal Advisors, and I input all the revenues and the expenses. So what we're doing is a comparison between Wilson Legal Advisors income statement from 2019 to 2020. So what we're going to do is if we look at these formulas here, what the dollar change is going to be is 2020's income statement sales revenue in this section minus 2019's. So if we look at Wilson's sales revenue for 2020, it was 48,750. Alright, in 2019, their sales revenue was 39,000. Alright, now I'm going to go through the formulas with you. So this formula is you're taking 2020's sales revenue minus 2019 sales revenue to get the dollar change. This percentage here is going to be the dollar change divided by 2019. So you take the dollar change and divide it by 2019. So you go equals this divided by this. And you get 25%. Alright, so we're going to do that with all of Wilson Legal Advisors income statement data. So we're going to go to interest revenue. Their interest revenue for 2020 was $1,350. So we're going to type in 1,350. We're going to go to 2019. And we're going to type in 1,425. 425. Alright, so here we have a negative 0.5% change from 2019 to 2020. Our dollar change here is negative 75. Again, you're taking the most recent year, subtracting the previous year, and then you're going to get the percentage change by dividing the dollar change by 2019's data. Alright? So we'll go down here and type in Wilson Legal Advisors expenses. So we have rent expense, that was $14,250. $14,250. In 2019, it was the same, $14,250. So we have no percentage change there. Our insurance expense was $8,750 in 2020. In 2019, it was $7,200. So we will have a 21.53% change there. Our depreciation expense for our truck. So this is depreciation expense for a truck. And I'm gonna type in 2020s as 3,550. And 2019 was 3,550. So they are using straight line depreciation there. It doesn't change. If they were using, I know we didn't get into detail with double declining depreciation, but if they were using double declining depreciation, the rate would be increase in it would increase the first year and then slowly decline as the asset depreciated. Alright, so we have 0% change there. Utilities expense. Our utilities expense in 2020 was $1,875. $1,875 and $1,220 in 2019. So we see a 53.69% change there. Our supplies expense was $1,530 in 2020. In 2019, it was $1,620. So we have a negative 5.56% there. Our telephone expense in 2020 was $1,300. In 2019, it was $740. So we see a 75.68% difference there. Our miscellaneous expense was $475 in 2020 and $500 in 2019. Oops, not there. $500 in 2019, and we see a negative 5% change there. Alright, so again, we're going to take the current year, or most recent year, so equals 2020's year minus 2019's year, and then we're going to take this equals the dollar change divided by 2019's data. And that's how you get your percent change. The dollar change is 2020, the most current year, minus the previous year's data. All right, so that is how you calculate the horizontal analysis for the income statement. Now, we can do a balance sheet this way and owner's equity statements as well. All right, so this is the income statement. Horizontal analysis, like I said, can be utilized on the 3 financial statements, but mainly it is used on the income statement or the balance sheet. When completing a horizontal analysis, account balances are compared across time to determine both the dollar and percent difference between them. Alright, so if we're reading Wilson Legal Advisors Comparative Income Statement here, if we're looking at this, we see that there was a 25% change in sales revenue. That means our sales revenue increased by 25%. That's a good thing, right? Our interest revenue did not increase, so we see a drop in our interest revenue. When we look at our expenses did increase here. If we look here at our supplies expense is in the negative percentage, so that could mean that supplies are being inefficiently utilized. And there's no single piece of analysis that can provide a full picture of how well a company has performed. However, these analyses are helpful in seeing how a company has been performing, and it's important to compare horizontal analysis with competitors' income statements from previous years. So you could do an income statement on competitors to see how your numbers compare to the competitors' numbers. So this is the horizontal analysis of the income statement. This is how you complete it. The next one we're going to be doing is vertical analysis. If you perform the horizontal analysis on a balance sheet, it's performed the exact same way. So you take the most recent year minus the previous year, you get the dollar change here, and then you take the dollar change divided by 2019 or the previous year to get the percent change. So that's how you would do it on the balance sheet. So you would do that on the assets, the liabilities, and the owner's equity to get that percent change. Vertical analysis of Wilson Athletic Advising. So unlike the horizontal analysis, where it calculates the 2 different periods or compares the 2 different periods, the vertical analysis compares account balances within the same period, so not in different periods. When you use the horizontal analysis in conjunction with the vertical analysis, you can get a bigger picture of how the business is performing. So what we're going to do in the vertical analysis is take the percentage. You'll see the percentage is displayed adjacent to each account balance. And how we calculate is by dividing the respective balance by the base figure. So the base figure within the balance sheet is total assets or total liabilities plus owner's equity. So for this example, you have $104,750. That's our base amount. All right, in the income statement, you're going to want to take total revenues as your base figure. So what we're going to do here is we're going to take the dollar amount divided by the base figure. So if you see here, we have the dollar sign in front and the dollar sign before the number. So what we're going to do here is we're going to put the dollar sign before, dollar sign before, and before this number here, and we're going to calculate it, and it's going to be 55.37%. Now when you put the dollar sign, it makes it a complete number. Alright? So when you go to calculate all of these, it will calculate that automatically, and it will be a complete number. Alright, so when we go through and do this, we're going to go equals G9, so that's the dollar amount divided by this base figure, but we're going to put the dollar sign to make it a complete number, and it'll calculate that all the way down. Alright, so you do the same formula all the way down for the assets, and then you do it for the liabilities. Same formula with the base figure of total assets or total liabilities plus owner's equity. It's the same number though. Alright, so this gives you a fuller picture of how the business is performing, especially when you do this, when you complete this with the horizontal analysis. So if we take this number, the cash, and you divide it by your total assets, you have cash is 55.37% of your total assets. When you look at accounts receivable is 12.41% of your total assets. Supplies is 4.06% of your total assets. Furniture is 7.64% of your total assets, and your building is 20.53% of your total assets. When all of these add up, they should equal 100% of your assets, right? But you always want your cash to be the majority of your assets, right? And of course, buildings are going to be a large chunk. Buildings or land are going to be a large chunk of your assets because they're so valuable. Now let's take a look at our liabilities. Our accounts payable is 22.91% of our total liabilities plus owner's equity. And our capital account accounts for 77.09% of our total asset or our total liabilities plus owner's equity. So that means the owners lay claim to 77% of the company, of the business. They lay claim to that amount of the business. So that means that they're doing really well because the owners own most of the business and they don't owe money. So only 22% of liabilities is owed. So you can see that this is a good way to see how the business is performing, and the horizontal analysis is another good way. Now you can complete this with the income statement as well, but you would use total revenues as your base figure, whereas using the vertical analysis with the balance sheet, you use total assets or total liabilities and owner's equity. So that is vertical analysis. Alright, so a common size financial statement is basically you're taking the information, the data from the vertical analysis, and normally it wouldn't show any data from the financial statements, it would just show the percentage change, but for this example we're going to show the data from the financial statement, the balance sheet. So for Wilson Athletic Advising, this is taking the vertical analysis that we did from 2000 or was it 2020? We're taking that vertical analysis and the most recent vertical analysis and comparing the percentage of the two. So what we're going to look at here is we're going to take the percentage difference. So we're going to take G8, which is the most recent year, and divide that by the total assets from that year. And then we're going to take the percentage from 2019 by dividing the cash from that year and dividing it by the total assets from that year. Alright? So again, when we put dollar amounts here, it's just telling Excel that it's an absolute number. So I'm going to go through it with you. Equals G8 divided by total assets, which that's our base figure. We're going to make it an absolute number, telling Excel that it's an absolute number by putting dollar signs here. Alright, and we see at 51.78%, the cash accounts for 51.78% of Wilson Athletic Advising total assets for 2020. Now we're going to do 2019. So we're going to do equals. We're going to take this number divided by this number. We'll make it an absolute number here. Oops, did something wrong there. This divided by this base figure. Let's see. Now I should have it right. And we see that cash during 2019 accounted for 55.37% of Wilson Athletic Advising total assets. Now we can go through, so you go through and put those formulas in here, and you get the percentage difference between 2020 and 2019 from the base figure of total assets. So we see that in 2020 our cash was 51.78% of our total assets, whereas in 2019 our cash was 55%. So our cash account decreased, right? In 2020 we see that accounts receivable accounted for 13% of our total assets, and in 2019 it accounted for 12%. So we're owed a little more in 2020 than we were in 2019. Supplies were at 1.97% in 2020, and they were at 4% in 2019. So we have less supplies. Furniture accounted for 11%. So we gained some furniture in 2020 that we didn't have in 2019. And building accounted for 21.2%, whereas in 2019 it accounted for 20.53%. So the building may have went up in value, right? So our building as an asset is 21.2% of our total assets. Now if we look at accounts payable, in 2020 it accounted for 30.57% of our total assets and total liabilities, whereas in 2019 it accounted for 22%. So we owe a little more in 2020 than we did in 2019. Our capital account is 69.43%, whereas in 2019 it was 77%. So our owners lay claim to less in 2020 than they did in 2019. You can see that they owe more money than they did in 2019. So that's how you look at a common size balance sheet. So basically it's a vertical analysis of 2 different years, and you're looking at the percentages between those 2 different years. Another way of checking the performance of a company, besides horizontal and vertical analysis, they don't give the whole picture. Another way of checking on the performance are ratios. So ratio analysis. We're going to talk about a few different ratios. First, we're going to talk about liquidity ratios, and there's 2 ratios that we're going to discuss that are under liquidity ratios. There's current and quick ratios. So current and quick ratios are both ways of telling if the company is able to meet its debt obligations, how well the company is going to meet its debt obligations. So we're going to look at Greater Athletic Performance and see how well they are meeting their debt obligations in March and in April. So I'm going to walk you through how to input the formula on Excel. So if we look at current ratios are current assets divided by current liabilities. So if you look here, we're going to calculate all the current assets. So current assets, remember, are assets that can be converted to cash within a year. So what we're going to do is I'm going to type this in for you so you can walk through it. Equals sum of current assets, all the current assets. We're going to close the parenthesis, and we're going to go divided by current liabilities. Oh, did something wrong there. Where's current liabilities? Divided by current liabilities here. Alright, so Greater Athletic Performance can meet their debt obligations 19.78 to 1. So they have 19.78 assets to 1 liability. So it's 19.78 to 1. Alright, now we're going to calculate April's, and April's is going to be a little different because we have to add all of their liabilities. Now remember, unearned revenue is a liability because you've been paid for something but you owe your service. So you've been paid for it but you have not completed the service yet, so you owe that. So it's a liability. So we're going to add these together. We're going to equals sum of parentheses, add all our current assets up, accounts receivable, and supplies. We're going to close off that parentheses. We're going to divide. We're going to put another parentheses. And we're going to add up the total liabilities here. We're going to close parentheses, and we are going to get a 10.08 I did something wrong. 1 second. Oh, that's because I'm on the wrong one. We're going to get 10.32 to 1 liability. Alright? So the higher the number, the better. So in April, you see that Greater Athletic Performance owes more than they did in March. So they owe more than they did in March. They still are able to meet their obligations 10 to 1, 10.32 to 1. So now we're going to do the quick ratio, which is cash plus short-term investment plus accounts receivable. Alright, so what we're going to do here, since they don't have any investments, Greater Athletic Performance did not have any investments, what we're going to do is we're going to just put 0 for the investments and add accounts receivable. All right? So we're going to take equals sum of cash plus 0 for investments to know that we do not have any investments, and plus accounts receivable. We're going to close that off and divide it by our liabilities here. And it's going to be 19.53 to 1. Right? So that's the quick ratio. That's, you can meet 19.53 to 1 of your liability. So it's 19.53 to 1. Now we're going to look at April's, and we're going to do the same thing, but we're going to add all the liabilities together, right? So we're going to go, one second, I'll delete this, equals sum of, we've got our cash plus 0 for our investment plus our accounts receivable. We're going to close this off and we're going to divide by our liabilities, and we're going to see what number we get. Alright, so we have 10.8 to 1. We can meet our debt obligation 10.08 to 1. Alright, so these are the liquidity ratios, and we're going to move on to solvency ratios. Now, just to review liquidity ratios, it is to see how easily a company is able to meet their debt obligation. So current ratio indicates how well positioned a company is to pay off that which it owes in the next 12 months. So those are the liquidity ratios. Is solvency ratios. Solvency ratios gauge a company's ability to meet long-term obligations. So an organization can raise funds through two methods. It can either borrow cash, which is a liability, or it can sell an ownership stake in the business, which is equity. Solvency ratios measure the extent to which each of these methods is utilized and the balance between them. So high solvency ratios or super low solvency ratios are not a good thing. So we're going to look at our solvency ratios. We have three different ones we're going to discuss. Debt ratio, which is total liabilities divided by total assets. You can see here. Total liabilities divided by total assets. We have equity ratio is total equity divided by total assets. So how much equity to assets is owned. Debt to equity ratio is total liabilities divided by total equity, and it expresses the balance between liabilities and equity. When liabilities exceed equity, this ratio will be greater than 1, while the reverse circumstance leads to a ratio that is less than 1. The equity ratio expresses the portion of assets that are generated through equity, and the debt ratio expresses the portion of assets that are generated through liabilities. So we're going to look at greater athletic performance, solvency ratios. So we're only looking at the first month, so March. So we're going to look at those. So if we take the first one, debt ratio, which is total liabilities divided by total assets, so we equals sum of total liabilities divided by total assets equals 2.09%. Now we're going to look at our equity ratio. So it's total equity divided by total assets equals sum of our equity, which is our capital, divided by our total assets, which is 97.91%. So what that says is Ann owns 97.91% to the amount of assets that they own. So she lays claim to $35,000 in the organization, and their assets total $35,835. All right, now we're going to do debt to equity ratio, total liabilities divided by total equity. So we're going to go equal sum of total liabilities divided by our total equity. So that is 2% of 0.02% of what Ann owes. She only owes $750, but she lays claim to $35,085. So it's 0.02 of what she owes. What it tells us is that Ann owes very little. It's clear that she has obtained the vast majority of assets through equity instead of liabilities. That's why the debt ratio is so low, and why the equity ratio is close to 100%. The result is that the debt to equity ratio appears very small. You see the debt to equity ratio is 2% or 0.02. And this is confirmed by comparing it to the industry average. While it is good that in comparison to its competitors that Ann does not owe a great deal to creditors, keep in mind that at times it can be beneficial to borrow funds. For example, if the company is presented with an expansion opportunity that can lead to significantly increased revenues, it may be worth borrowing the funds and paying the associated interest to be able to take advantage of the opportunity. So one key to effectively running her business is finding the appropriate balance between debt and equity. So as you can see, Ann owns the majority of her organization. She does not owe for liabilities. So these are the solvency ratios. And we can see that Ann is sole owner of the organization and almost owns 100% of the organization. So we're going to talk about profitability ratios next. Ratios, they provide insight into a company's ability to effectively generate income. The two we're going to be looking at is profit margin and return on assets. Profit margin indicates the percentage of revenue that a company converts to net income. Companies seek as high a profit margin as possible, as this indicates that the company is efficiently generating net income. Return on assets illustrates a company's ability to use assets to generate net income. Similar to profit margin, it is preferable to have a higher return on assets. So we're going to look at greater athletic performance, profit margin, and return on assets. So profit margin, you take net income divided by revenue. So we're going to look at March and April, but we're going to need greater athletic performance income statement. So we have the income statements below the balance sheet. So we're going to do equals sum of net income divided by total revenue equals 13.86%. So it's not a super high profit margin, but they are making money, right? They're just starting off, and they are making money, so it's beneficial, especially with a company that's starting off. In April, their next month equals sum of net income. Net income, their net income's a little higher here, divided by total revenue. And they have a 23.45% profit margin in April. Now we're going to do return on assets, and then we're going to look at all the numbers together as a whole. Return on assets is net income divided by average total assets. Since March was Greater Athletic Performance first month of operations, we're just going to take their total assets. All right? So we got to do net income divided by total assets equals sum of net income divided by total assets. And we get 1.35%. Then for April, we're going to take the average now. So what I did here was I took the total equals sum of total assets plus total assets plus the total assets from April, close off the parentheses and divide it by 2 because there was 2 months. This is how we get the average. Alright, so we take the total of both months and divide it by 2 to get the average of 34,555. So when we calculate this, we're going to take equals sum of net income from April. So here's April's net income. And we're going to divide it by the average total assets. Alright, and we get 4.04%. So both the profit margin and return on assets increased from March to April. These increases were significant in both instances, and therefore indicate that the company is now doing a better job of converting revenues to net income and using the assets to generate net income. Ideally, Ann's Greater Athletic Performance would like to see this trend of improving profitability ratios continue into the future months. So as you see, they did improve from March to April, so our profitability is increasing. So these are the ratios that you'll need to know. Current ratio, quick ratio, those are both liquidity ratios. Debt ratio, equity ratio, debt to equity ratio or solvency ratios. Profit margin, return on assets are profitability ratios. And you're going to need to look at both the balance sheets and the income statements for profitability ratios. For liquidity and solvency ratios, you'll need the balance sheets.